All right. Well, thank you for your attending tonight, and thank you for those that have joined us virtually online. This seminar is on long-term tonight, and we have a PowerPoint prepared for you. Before we start with that, though, I think, Andy, we should introduce ourselves.
Yeah.
I'll begin. So my name is Bob Skillings, and I'm with SouthPoint Investment Services. And not only investments, but we work with insurance as well. And that's why we're having this seminar tonight on long-term care insurance. I've been in the financial markets industry for 15 years, 9 of those here at SouthPoint. My primary office is here in New Ulm, but we have 7 locations, and I find myself almost at all of them in the course of a month or two, working with members. So SouthPoint Investment Services is a benefit to the members. You, the members, own SouthPoint, and SouthPoint Investment Services is a benefit to you. And so when I meet with members on various subjects, oftentimes I get asked, well, what do I owe you for your help? And I say, you owe me nothing, because SouthPoint Investment Services is a benefit to the members. So,
Yep, my name is Andy Barnick, and I'm also part of the investment services team. I work out of the St. Peter and Mankato area. Also visit other offices like Bob. I'm a graduate of Gustavus College and live in St. Peter with my family. And I've been doing in the investment world for about 20 years. Try to focus on a little bit of everything like Bob, do full financial planning. So today we're going to talk a little bit about long-term care insurance, which is a very important topic, especially with the baby boomers reaching that age range of maybe needing it in the next 10, 15, 20 years. But also, as Bob would attest, if there's any other need, whether it be a investment, retirement question, we're always here to help you guys out. So this might just be something that gets your ear for today, and we're happy to meet with you guys later and get in detail and talk about long-term care insurance. But if there's anything else that comes up down the road, we're always here for you.
So Andy, some of the other things that we do help members with, I kind of have a list here.
Oh, great, a list.
Retirement accounts and retirement planning, in just general investment ideas. We also evaluate life insurance needs and existing policies. And of course, tonight, long-term care insurance. We also work in the area of health and disability insurance, business benefit plans and succession planning, estate planning. We're not attorneys, we're not tax accountants, but we're very familiar with the ideas and the language. And so in estate planning, oftentimes wills, probate, trusts, asset management comes up, and we can be helpful in those areas. Also with tax planning, again, we're not tax accountants, but we can help guide members. Education funding, 529 plans, etc. Social Security and Medicare. So those are the different topics that we oftentimes cover with members when we visit with them. So on to our presentation tonight, Protect, Preserve, Provide. This is a PowerPoint, and so we're going to go through several screens, and I would suggest that as questions come up, maybe you can follow along. Those that are here in attendance actually have a printout of our PowerPoint, and so if a question does come up, just jot it down. Please don't ask it while we're going through the slides at this point, but at the end we'll take the questions. So just an overview of the slides that we're going to show. We're going to start out with a definition of long-term care, then also cover types of long-term care services, the different funding options for long-term care, protecting assets through the long-term care partnership, and types of long-term care insurance, and how long-term care policies pay benefits. I know you can't see or read that on your screen, but there's a couple sentences in there I just want to read. This presentation is designed to provide general information on the subjects covered. It is not, however, intended to provide specific legal or tax advice and cannot be used to avoid tax penalties or to promote, market, or recommend any tax plan or arrangement. That's just our disclosure. You have your asset protect edge. What is long-term care? It's a broad range of services provided over a prolonged period. Purpose is to minimize or compensate for loss of physical or mental functioning resulting from an illness, disability, cognitive impairment, or simply the frailties of old age. Often involves the supervision for a person with cognitive impairment so they will not harm himself or herself or others.
When is long-term, when is long-term care insurance, when is long-term care needed? So healthcare professional determine that a patient either has a physical or a cognitive issue. So the physical issues would be that the patient cannot handle activities of daily living. So bathing, dressing, toileting, transferring. Continence. I think you guys, I'll leave some room for the imagination there. Anybody have an idea what continence is? Yep, okay. Eating, we'll come back to these 6 a little bit later in the presentation. Cognitive impairment is always associated with long-term care need, I think more so than physical stuff sometimes, is a significant diminishment of reasoning. It's always, you always think of Alzheimer's in that situation. This is an impairment can result in confusion, disorientation, impairment, judgment, and memory loss. Either situation might benefit long-term care services.
Types of long-term care services. Home health care can be for personal care, supervisory care, nursing care, therapy, and homemaker chore services, all within the home. They're becoming much more prevalent these days. Another type would be community-based care. It includes adult day centers, senior centers, as well as transportation services and home delivered meals. Residential care allows for independent living spaces while having access to needed personal care and household support services. Skilled nursing facilities offer a wide range of services, including 24-hour nursing care, supervision, assistance with ADLs or the activities of daily living, and various types of therapy. And when it says skilled nursing facilities, we commonly know that as nursing homes, okay? Some patients may be in this type of facility for a short time after a serious illness or operation and then return to their own home. Others are in this type of facility because of chronic illness or disability and will live there until they die.
So we'll look at a few statistics here. A lot of the folks that are probably joining us are of that age of the baby boomers, where they're maybe looking after their children, grown children, grandchildren, and also their parents, right? So these statistics are going to be coming from, as you can see on the slideshow, from the U.S. Department of Health. It's really long-term care claims from 1974 to 2009. So we know that the biggest generation in American history is coming after that. And so when we look at these statistics, we're probably only going to see the percentages increase, which is the reason why we're bringing this presentation to you guys. It's a big issue. So 70% of people over 65 will require long-term care services. Huge number. Nearly 79% of long-term care is received at home or in a community setting. The average stay once we're in a long-term care facility is almost 4 years, 3.8 years. So it's a long time. We look at cost, you think about 3.8 years, almost 4 years as an average stay. You look at some of these costs, and I think most folks, you know, my grandmother was in a nursing home, spent on all of her assets, had to sell the home and all that good stuff. You know, only a couple of years, you know, look at yearly costs there on the bottom, nursing home care, 90,000 to 102,000 is going to be determined on which state you're in. You can see assisted living costs, $48,000 per year. Adult daycare, $19,000 a year. Home health aid, $51,000 per year. So you can see 4 years in a nursing home. The average American probably isn't going to have just $400,000 lying around, right? So that's what we're here to talk about today, is how can we protect the family's money, right?
So Andy, personal experience, I was power of attorney for my mother, who passed away about a year ago, but I took care of her finances for about 3 or 4 years before she passed. And she ended up in a nursing home for over a year. And she had to, she basically paid her own way, but didn't have enough assets to pay her entire period of time. At the end, the last few months, the cost of her care was about $9,300 a month. And so I do have personal experience in working with someone that had to go through that whole situation and rely upon what we'll get into a little bit more, Medicaid, which is a government program that helps those once their assets are exhausted. And so that process of applying for Medicaid is fairly complex. I've gone through that, so it's given me some good experience, good personal experience that I'm able to share.
One important thing to notice, he talks about Medicaid in a second here, is never want to go and apply for Medicaid until you have all your ducks in a row, right, Bob?
Correct. So national average, Andy, thank you for going through that. The next slide here shows our funding options for long-term care. And there basically there's 4 options for us to pay for our long-term care needs. The first one on the far left is labeled as portfolio, but basically that means that you're using your own assets, you're self-insuring. You're going to pay your own way with the assets that you have. That's the first way. The second way would be long-term care insurance, which we will continue to talk about this evening. The third way would be what's called reallocation of your assets. And there's 2 reallocations of assets. Number 1 would be an annuity, that you would move assets into an annuity that would help pay for long-term care. And then the other reallocation choice would be life insurance, okay? And both of those you might hear commonly referred to as hybrid long-term care policies. And we'll get into more detail on that. Then the fourth one is what I just touched on personally, and that's called divestment social insurance. So basically that means that you use Medicare, early on Medicare benefits, but then later long-term you use Medicaid benefits, which is basically the government helping to pay for your care. So those are the 4 different funding options.
The main reason that you buy an insurance policy or a combination product insurance policy is to protect your assets, correct? So what I'm going to talk about here is what happens if you don't buy a insurance policy. So this is called self-insurance. So this would be for somebody who, does not buy a policy, so they plan on paying it out of their own funds. So that means selling off property, selling off, retirement accounts, using all of their funds in their bank accounts. This is what happened to my grandmother. She lived in a nursing home for 9 years. So by year 2, nothing left. My dad had to balance the checking account. She could only keep, she was a widower, so she could only keep so much in her account. At the time, it was about $3,500. That's all she could have from Social Security. So even if there are enough assets to pay for care, that may not be the original plan. So even if you have more money than maybe my grandparents came from, might not be the best plan, because we want to protect those assets. Also, consideration is we have retirement assets, so market conditions, whether that's through property or retirement investments, the time of needing those monies might be a time when there's a downturn in the market. So if you remember 2008, when we had the financial crisis, 2009, it wasn't a great time to pull money out of your retirement accounts at that time because the market was an all-time low, right? And if you would have taken the money out at that time, you wouldn't have seen it grow back to where it is at this point. Also, you take a big account, especially if you're a married couple and or you have children that you want to leave some of your hard-earned money to. You think of the standard living of yourself, but also for your family. That's the biggest reason that most people buy policy. And that last bullet is ability to pass on assets to their beneficiaries. So.
So the next way to fund long-term care needs is actually the fourth one that I went through initially. And that was the divestment, social insurance. So Medicare is a national insurance program designed to provide benefits for hospitalization, surgery, and physician's care. Medicare provides very little coverage for extended long-term care expenses. What Medicare does cover for a nursing home would be the first 20 days of care that is approved by a physician. And then the next 80 days of care, only above $164.50. And that figure may have changed. This figure is probably a year or two old, so I don't know if it's changed, but so anything so personally, a person would have to pay the first $164.50 of care per day before Medicare would pay the remainder for the next 80 days. Okay, so beyond 100 days, Medicare pays nothing. You pay all expenses. So that's when Medicaid could potentially kick in if a person no longer has assets that they can use to pay the whole bill. That's when Medicaid would kick in and pay like my mother had to do towards the end. Medicaid is a joint federal and state health program that provides medical assistance to low-income families. Persons applying benefits must prove they do not have the ability or means to pay for their own medical care. A lengthy questionnaire must be completed, disclosing all assets and income. And personally, I know that is true. It is lengthy. And
it's different in every county too.
And yes, and it's ruled by each county, and like Andy says, maybe different in different counties. In general, though, a person can keep $3,000 of personal assets, and that's it. Okay, so when you get down to your last $3,000, and then the government has to begin paying, that's what Medicaid is. States will also impose a 60-month look-back period. So some people think that they have, whatever amount of assets, but they can get rid of them before they need to go into a nursing home. Well, when it says most states will also impose a 60-month look-back period. So basically that means that if you give some of your assets away, make sure that it's before you go in 5 years before you go into the nursing home. Because if it's during that 5-year period, then they will force the family to come back with those assets and pay for that care with those assets.
Some counties are a little bit more aggressive than others in collecting funds.
Transferring funds during this time will cause a period of ineligibility equal to the amount of the transfer divided by the state's average monthly cost of a nursing home care.
So asset protection. So if we buy a qualified long-term care policy, that has a partnership with your state, you may protect assets from Medicaid spend down and asset recovery. So that means you have insurance covering you, so you're not doing what I talked about earlier, paying out of pocket, right? So we're not liquidating bank accounts, retirement accounts. The insurance policy is paying at least some of the bill. Part of that might be Social Security or pension. All those three might kick in together to do it. Every case is a case-by-case scenario because there's not a one fit all. So that's why it's important to meet with a financial advisor or insurance agent to talk about your exact situation. You no longer have to hide assets, as Bob mentioned, that 60-day look-back period. So you can let your assets continue to grow, not worry about giving them away, right? You must declare the assets to protect to be protected at the time the Medicaid application is submitted. So that's what I mentioned before we talk about that Medicaid application. We really want to have all of our ducks in a row so that we're all settled on the application and we don't put anything incorrectly on there. Partnership policies are portable, provided the new state participates in the partnership program. So if you bought a policy in Minnesota from Bob, but then you decided you want to be a snowbird and move down to Florida, I want to talk to Bob about that actual policy bought and if there's a partnership there.
So just in general, the long-term care partnership program, what that does is, let's say you have a policy that will pay for $200,000 worth of long-term care in a nursing home. Okay, what the partnership will do then is allow you to protect $200,000 of your assets, and then and let's say you're down to 200,000 now. Now it's time to have Medicaid kick in and continue to pay for your nursing home services. Okay, so they can't come and say, we want that 200,000 because we're paying for your services. No, that's protected. So that's what that partnership is all about. That's why we buy a long-term care policy, to protect a certain amount of assets that then we can leave to our heirs or whatever. Or maybe it's land that we don't want to sell. So number 2 on my list of 4 was long-term care insurance. So most long-term care insurance policies are comprehensive to cover all levels of care. And you might recall on an earlier slide, we not only talked about nursing home, but we talked about home-based care and adult day care, transportation costs. I mean, we went through the whole list there earlier. So, but most policies will cover all levels of care, not just nursing home care. Most are tax qualified. So you're protected from having to count benefits as income and pay taxes on it. Not need to do that. Most are reimbursement type policies. So as you accrue services and the cost of services, a policy will reimburse you and help pay for those services. If requirements for partnership are met, policy will be considered a partnership qualified policy and will allow the policyholder to protect assets if applying for Medicaid in the future, like I mentioned. The basic components of long-term care policies. So they pay out either in a daily format, a weekly format, or monthly format. They can cover years of benefits depending upon the policy. They generally have an elimination period, which commonly would be 90 days. And so the policy, once you go in and need long-term care services, the policy doesn't actually kick in until after 90 days. So it doesn't start paying for you. But remember what Medicare covered. Medicare covered, the first 20 days completely, and then after that, up to 80 more days. And it didn't cover it completely, so that elimination period, if you set it at 90 days, usually that's the most affordable type of long-term care insurance, if you set up the elimination period to be 90 days. And then an inflation rider is an important aspect of a policy. When you decide on a certain amount of benefits that you want to pay for, you want to make sure that there's an inflation factor in there of 2% or 3% or 4%, because we all know that healthcare doesn't stay static. We take the policy out when you're 60 and need it when you're 80. There's going to be a big difference in cost of services in those 20 years. So that's what an inflation rider will help with long-term care policy. And then there's some optional benefits that you could have tied to the long-term care policy. Spousal shared care. So in other words, you could get a joint policy together. Also a spousal waiver and premium would be basically if one of the couple needs long-term care services and you have this waiver, you no longer have to pay for the insurance because the benefits have started to kick in. And then some cash benefits to help with the costs as well. Factors to consider in taking out a long-term care insurance policy: your age, your health, marital status, and then there are long-term care group policies that employers might offer as well. Just so you know that if you're an employer or work for a company, that might be a benefit that could be added to the benefits of the company. Price should not be the primary consideration.
So, like I mentioned before, there's not a box you can put each person in. Not everybody's going to need the exact same thing because everybody has a different financial situation, different family situation. And so the first kind of a hybrid product that we'll talk about that isn't what Bob just talked about, which is just your pay and go policy, is an asset-based combo product. So it's kind of a combination between a long-term care policy that Bob described and a life insurance policy. So it has a linked benefit life, it's called a linked benefit life product, have been around for about 20 years. If a client needs long-term care benefits, they are paid out at the time of the death benefit.
Paid out of the death.
Yeah, I'm sorry, paid out of the death benefit, sorry. If client stays healthy, the entire death benefit is paid to the beneficiary. So that's great, So we have that idea of insurance. Hey, I'm paying this premium all these years. And then what happens if I hopefully never have to go to a nursing home, right? You're like, oh, geez, I paid all that money and then I never got to use my long-term care policy. So that would be the best situation, right? Sometimes people get hung up on that. So this is that for that person. Most policies also have a residual death benefit, even if all of the death benefit has been paid out because of that long-term care need. And also I talked a little bit about, and Bob also talked about partnership. This is not a qualified partnership program. This is kind of a nice little display, shows several different scenarios. Sorry, are they seeing this on the, at home? Okay. So you can kind of look at it here, and like Bob mentioned, you can kind of see here, and these are guesstimates on how much these premiums are costing every year. So traditional long-term care insurance, you might look at that premium and go, "Ooh, you know, what if I never need that insurance? Wow, it's a lot of money I've just paid," right? And that's where some of these hybrid products come into play, especially like this life insurance product. So I never need to pay that. I end up getting my premium paid back to me when I die. So my kids get that. Whereas the traditional product, you know, generally you're not going to get anything back at the time of death. So kind of, and Bob's going to talk about another one here, which is an annuity hybrid product. But they're also come into play, especially with a couple. So you can see asset care, second to die, where it pays up to a certain point. The premium is much, much lower than you're seeing from the traditional long-term care policy. Now there's some situations there on how much the partner can spend every month and keep, as far as asset wise. So that's why it's really important to talk to a financial advisor or an insurance agent, because like I said, every situation is very, very different. So you can see that asset care second to die life, asset care second to die life state. We can see the premium difference. We can also see the lump sum premium. So that might be somebody that just has, especially with, we're in the credit union and we know our interest rates are better than most banks, but interest rates in general are very low right now. So if you're somebody that has a bunch of money in savings, you know, why not put it into one of these policies if you're not using the money or you don't see a need for the money? And then it's called a paid up policy. So worst case scenario, you don't use the long-term care insurance and that money would go tax-free to your beneficiaries. So something to think about. Now, Bob's going to talk about another version of a combination product, which is their annuity based.
Correct. Before I move on to that, I just want to point out, so the three different scenarios for having a second to die life insurance policy that also would pay for long-term care. So so the example here is you pay to 95, age 95, and that premium is about $8,600 per year, okay? So it would take to, and so that if you didn't need those to use it for long-term care, then the death benefit on that would be $166,000, okay? So that's about 19 to 20 years of paying premium to get to equal what the life insurance is going to be. And so if this is Linda and Tom at age 60, so basically that means that by the time they pay, or by the time they reach age 80, they will have paid the $166,000 in premium. And are they ready for the nursing home at age 80? Well, the way things are going these days, people are living to ripe old ages, and so that option, you know, might not be the best to just pay as you go every year. The next one is a 10 pay, and so you just have to pay for 10 years, and that's $16,000 per year. And so that basically equates to the death benefit of $166,000. Okay, 10 times 16 is 166. So you kind of break even with that scenario. But once you made that payment for 10 years, you're done. And then the last one, which is the best, which Andy pointed out, is a single pay of $132,000. So you have assets that really aren't doing much at this point for you. You just move them into a policy like this, and then the death benefit, if you never need long-term care services, is going to be $166,000.
We'll oftentimes see that third scenario with somebody who is more leaning towards assets that they consider themselves a conservative investing. meaning that they're not gonna take any risk with it anyway. So might as well just pony up and the whole premium in that.
Yeah. So moving on to the other hybrid long-term care policy, so to speak, would be the annuity version. So it's a linked benefit annuity products available as provisions of the Pension Protection Act that took effect in 2010. If the client needs long-term care benefits, they are paid out of the premium account and then the long-term care account. If the client stays healthy, the entire premium account value is paid to the beneficiary, just kind of like the life insurance, only it's the annuity. If all of the premium amount has been paid out in long-term care benefits, there will be no account value to pass on. So you've exhausted it using long-term care. This type of policy is also not a partnership qualified policy. The difference between the two hybrids, I think, is what your health is. You know, so to qualify for the life insurance version, would take more from a health standpoint. I mean, you need to be healthier to qualify for that. Whereas the annuity, you still have to go through health questionnaires, etc., but they're not as stringent. So the annuity version will probably be more apt for someone that isn't as good.
There's also cognitive issues. You forgot, you get a phone call and have to answer questions. Some people are very sharp, but they're just not ready. They take it at the wrong time. Just say. So how these policies, how they pay the benefits. So regardless of design, all of these policies pay benefits the same way. So healthcare professionals, now I'll say we talked earlier about those ADLs or activities of daily living. So eating, bathing, dressing, grooming, mobility, or and then toileting, cognizance. I can never pronounce it. Continence. There you go. So those play a huge factor if you want to step back about.
What happened? One more.
There we go. Yep. So regardless, those play a huge role. And then right below that, it says diagnosis of cognitive impairment. So those are going to be really important. So healthcare professionals certify to the insurance companies that the client is chronically ill, either due to physical or cognitive illness. So we talked about those 6 categories. So
Move on.
yep, move on. So
This is part of
how these policies pay the continued, once the elimination period is met, and Bob talked a little bit about that. So what, we have Medicare and Medicaid, when the elimination period is met on the policy, generally you can pick your elimination period. The closer the elimination, the sooner the elimination period, so it might be 60 days or 90 days. Your policy is going to be obviously more expensive the sooner that the insurance will pay up. So what's the most common elimination period that you've sold in, Bob?
90. It's 90 days.
90 days. So kind of along the lines he was talking about Medicare. So the policy will start to pay out benefits based on how the policy was designed. So how much you're paying up in premiums and how much you're expecting to get paid out. Benefits will continue until benefits are exhausted or policyholder dies, whichever comes first. All benefits paid by traditional or combo products are tax-free to the policy holder.
So we're getting to the end here. And I find this slide one of the more interesting slides that we have tonight. So we spend a lifetime building our estates, and we purchase life insurance to minimize our estate, the risks to our estate. We buy homeowners insurance, and you know the fire risk for homeowners insurance is 1 in 96 is the risk. We all buy auto insurance, The risk of an accident is 1 in 5. Okay, but do we all buy long-term health insurance when the risk actually is greater than 1 in 2? So many of us sort of avoid thinking or acting on our health risk, and that's probably the one that we'll see the most often within our lifetimes. What are your plans for when your health changes? So thank you for attending this evening, everyone, here and online. Many people think long-term care has to do with the individual. Reality is that it's a family issue. Think of it this way. The question is not who will take care of you, but what providing that care will do to your family finances. Long-term care insurance allows your family to provide the care you want at home or in the community, longer and better. It also protects assets that you have allocated to pay for retirement needs. So there's our information and how you can get a hold of us. I did notice that in our email address, it says SouthPoint SIN serve, which is not correct. It should be fin serve. So if our email addresses are important to you, it would be SouthPoint F as in Frank, finserve.com. But otherwise, our phone numbers are correct. So we thank you for being here tonight. And now we're available for any follow-up questions that you might have. Don't all speak at once now.
One thing I will add that maybe we missed that Bob's probably heard more than 1,000 times is you'll be meeting with a client and they'll say, well, so-and-so will take care of me. Or so-and-so will take care of me. Or so-and-so will take care of me. And then something happens. And maybe they hang on for a while. Maybe they even hang on longer than you expected. But then they have to change diapers and they have to do some heavy lifting and it just isn't manageable anymore. So that is great. We always want to protect our family and say, hey, I'll take care of mom, or I'll take care of dad, or I'll take care of grandma. The reality is most of us aren't well equipped enough to do that because we still need to put money on the table for our families. We can't spend 40 hours, 60 hours, 80 hours taking care of mom, dad, grandma, and grandpa. So that's an important thing to think about, right, Bob?
Yep. So those of you that are online, if you do have a question, you can unmute and ask it. We'll hear your question.